Well, good morning. It's Monday, February 9th at 11 a.m. here in Long Island. It's still bitterly cold, kind of feels like being in the movie Zhivago. Um, there's like a layer of ice on top of the snow. So we're expecting 40 degrees on Wednesday, and we'll see if that makes some progress in getting rid of the snow we had from the last snowstorm. But all in all, it's a sunny day. Really, no complaints. Sunny days in the stock market, at least since Friday, and things seem to be still on the upside or moving towards the upside today. So things are looking all right. Um, I hope that over the weekend you enjoyed watching the Super Bowl, whether you're team one or not. That's always good to watch. The commercials I thought were actually pretty disappointing. I didn't think any of them really stood out as particularly interesting or funny. A lot of them were hard to understand where they were going with them. And then, of course, the halftime show was controversial. I couldn't understand a word that the guy was singing. But anyways, let's move on to what we like to focus on, and that's the U.S. economy, the global economy, U.S. financial markets, global financial markets. I guess I've been feeling more optimistic about things of late as I'm thinking about 2026. And as you know, I've already been quite optimistic, so I'm feeling even more optimistic, particularly about this year, 2026. This is the seventh year of the it's a 7 year of the roaring 2020s. So we've got 26, 27, 28, 29. We've got 4 more years to go. The end of the decade is the end of 2029. I'm still thinking that we're not going to have a recession between now and the end of the decade, basing that on the resilience of the economy so far during the roaring 2020s. It's been hit by a lot of shocks, and yet it continues to grow. We had one recession lasted all of 2 months back in 2020, but that was not really a legitimate recession. So it's really we haven't had a recession since the 2008 great financial crisis. So the economy has actually been remarkably resilient for quite some time. If resilience is measured by uh, the frequency of recessions. And again, we just haven't had a recession in quite some time. I think we can also conclude that because of the resilience of the economy, earnings have been remarkably resilient for the S&P 500. And indeed, they've been so during the current roaring 2020 scenario. I think they'll continue to be very, very strong. And looking at real GDP, we're thinking that real GDP is going to be growing back at least at its historical pace of 3.1%. If you actually look at the GDP measure, let's do that. Let's get into the charts here. So I'm not doing a monologue and then repeating what I had to say in the charts because I think we do have a lot of charts to go through. So let me get right into it. Okay, so February 9th, the morning briefing. And the morning briefing is all about 10 good reasons for remaining optimistic. The outlook for real GDP, in our opinion, is looking quite good this year. It was really pretty good last year. The last 3 quarters of 2025 were really very strong, averaging about 4%. That's great. And most of that was based on productivity. So we had strong productivity-led economic growth in the last 3 quarters of 2025. So the question is, what will 2026 bring? And it should be more of the same or even better because there are more stimuluses that are being thrown at the economy this time around. So we're looking for real GDP to grow between 3.5% and 4.5%. 4.5% sounds overly optimistic, but it is the Roaring 2020 scenario. And it is the notion that productivity will be continuing to uh, boost real GDP. This is a chart of the real GDP over the past, well, since the beginning of the data in 1948, first quarter of 1948. So if you look at the data that we have uh, for the 1900s, so that's from 1948 to 1999. That we had that here somewhere. Average over time. Oh, here it is. There it is. Average through 1999 is up 3.6%. Then we've had this disappointing growth rate of 2.1%. And remember, a lot of people were saying that that's sort of the stall speed of the economy. And so there was a lot of concern that the economy would fall into recession. But it really didn't. I mean, it did obviously stall with the tech wreck in 2000, and then we had the great financial crisis. And maybe it's the fact that we had two significant recessions why the growth rate was disappointing. But even when the economy was growing, it was still kind of growing around 2%. So the average over time is 3.1%. And again, we're looking for this year to be 3.5 to 4.5%. And that might be the outlook actually for the rest of the decade if things continue to go along as we're expecting. This is just a quick look at the growth rate of real GDP. We had that drop off in the first quarter. That was when we had all the uncertainty about tariffs. The economy proved remarkably resilient and bounced back over here in the second quarter, and then it was even stronger in the third quarter, notching up 4.4%. And now the Atlanta Fed, I think I got that right here, is projecting currently that real GDP is going to increase by 4.2% in the fourth quarter. So that's a pretty good pace. The year over year is still on the disappointing side at 2.3%, but again, we're anticipating that what you saw in the first two quarters, the second and third quarters, and now the fourth quarter, may be the beginning of the, the, the the real excitement in the Roaring 2020s when it comes to real GDP. I mean, so far the Roaring 2020s has been exciting in real GDP in the sense that it's been resilient. It's grown despite the tightening of monetary policy, despite the pandemic, despite the tariffs, and yet it's continued to grow. So I think we're kind of at the sweet spot where things get sweeter over the rest of the decade. And again, as you know, this is not doesn't come with a money back guarantee, and I'm not telling you this is the only possibility. But and I continue to assign it a 60% probability, which doesn't sound like I'm roaringly optimistic about my own forecast, but actually there's a 20% probability that we have a melt up because it's too much of a good thing. So 80% that the economy is growing or booming, and 80% that we're in a bull market. The only problem with a melt up is it could lead to a meltdown. But so what? We've lived through that before. It's turned out to be a buying opportunity. I'll do my best to tell you it's a melt up and you got to get out at the top and then get you back in. But I've tried that a few times in the past. Sometimes it works, sometimes it doesn't. But mostly I'll tell you to stay in the market, and I'll probably tell you that there's some great opportunities to buy here. But again, it's a very low probability. And then just to be balanced, I throw 20% in for things, everything that could possibly go wrong. Maybe I'll have to sit down and see if I can come up with 10 reasons to be pessimistic about this coming year. We'll see. Right now, let's focus on the optimistic story here. This is looking very good. This is the try to keep you posted on this chart every week. This is analyst expectations for 2027. Why do we care about 2027? Well, because the market cares about 2027. The market is a discounting mechanism. It discounts over the next 52 weeks, 12 months. And forward earnings is the time-weighted average of analyst expectations for this year, which is 2026. And increasingly, this will be converging towards 2027. Now, you can see the analysts are talking about they're estimating that last year we came in at around $274 per share. That's probably pretty accurate. This year they're expecting $314 per share. We're expecting $310 a share. So they're already more optimistic than we are. And then for next year, they're expecting $363 a share, and we're expecting 350. So we thought we're optimistic, but the analysts who usually aren't quite as optimistic as strategists seem to be getting feedback from the companies that things are getting better and that the outlook is improving for this year and especially for next year. So the forward earnings all-time record high. We can look at, we've shown you this chart before. This shows you our expectations for earnings over the remainder of the roaring 2020s into the roaring 2030s. Got our fingers crossed that the 2030s will be roaring rather than kind of like what we saw back in the 1930s. God help us if that happens, but we'll try to keep you abreast of how things look to us, anyways. So this number is too low. We'll have to raise that to something like 275. But then this year we're using 310, 350, as I said, then 400, 450, and then at the beginning, the beginning of the next decade, 500. So we're thinking that the market will be discounting $500 a share at the end of 2029. Multiply that by 20, you get 10,000. So that's the simple arithmetic on our bullish outlook. And again, it would help a great deal if there's no recession in that outlook, and that's the way we're looking at it. Just for fun, we're also showing you the data we looked at just in this previous chart. This time they're just dotted series. So 2025 is here. Now we're in 2026, and you can see that they're edging up above our forecast, and the 27 numbers edging up as well. That doesn't mean that they aren't that we need to raise our numbers, but we are thinking about it actually for this year. What are the 10 reasons to be optimistic? There. Okay, then let's start out with the consumer, the OBBBA tax law that was passed last year by some estimates. I think the Treasury has an estimate that the average tax refund will be up by $1,000. So instead of $3,000 because of the refunds from last year, they will be $4,000 for on average for taxpayers. So that's a sizable stimulus, and that will obviously have an impact on disposable income, which is what we see here. Some people have been fretting about disposable income flattening out, and I've been pointing out, well, that makes sense. The baby boomers are retiring. A lot of them have high wages and salaries, and so as they get replaced by younger people with lower incomes, this could lead to a flattening out of disposable income, but real disposable income. But for now, we're going to get a boost in that. And I've also pointed out that we shouldn't worry too much about a flattening of real disposable income if it's in fact related to retiring baby boomers, because they will spend their retirement assets, which are substantial, and we'll review that again in a second. So consumption continues to go up, certainly over the next several months with the refund checks. And then, as I said, the savings rate's going down. And again, we can fret about that, say, that's not good. It shows consumers are under stress. Au contraire, what actually is going on here is baby boomers are retiring, and on average, they're sitting on a lot of retirement assets. And so they're going to spend that and not have any more labor income, no more paychecks. So here we've looked at this as an update through the third quarter. Look at this. We're up to $88.5 trillion dollars in the net worth of uh, the household, the baby boom households, and the total is 172.9. So 52% of household net worth is held by the baby boomers. It's the richest retiring generation ever. And back here, they didn't have much going for them. But as I've said before, we listened to Spock from Star Trek, and he said, "Live long and prosper." And baby boomers have been doing that. And I can't imagine that they're going to be able to spend it all. So the younger generations up here are going to get some pretty significant windfalls here from their parents. This is the same thing for uh, household corporate equities and mutual fund shares by generations. And again, it's over 50% of basically stocks, this category of stocks and mutual funds. We're talking about $30 trillion held by the baby boomers, and that's more than half of the total of $56.4 trillion. Over the years, I recall people fretting that once the baby boomers started to retire, they'd be selling all of their assets and the stock market would go down. I don't think everybody said home prices were going to go down, but there was a lot of concern that the baby boomers, while they were working, were creating a high, a bull, were fueling the bull market, and that once they retire, that would no longer be the case. Well, that's not the case, and what is happening instead is the stock market continues to go up, and the baby boomers are enjoying it to the extent, and others, more than 60% of Americans own stocks, according to the Gallup poll. And so I think there's a huge wealth effect occurring from this. And you can kind of get a glimpse of what the wealth effect does to the savings rate. People save less because they don't need to save as much if they own equities and their portfolio is going up. They also own houses, and those values have gone up. So that also contributes to a lower savings rate. Here's the Gallup poll chart showing you that more than half of Americans have some exposure to the stock market. This is assets in IRAs, and you can see in the second quarter they're up to $18 trillion, all-time record high, and that's the second quarter of 2025. Markets gone up a lot since then, and so we're probably looking at something like $20 trillion in IRAs. And so here's the market cap of the various measures, Wilshire, S&P. And so this is a very important source of a positive wealth effect, which continues to drive consumer spending higher. Second reason to be optimistic is the second was wealth. So consumer refunds. Second was the wealth effect. Third is the technology boom. This is high-tech capital spending and nominal gross domestic product. It's $2.3 trillion, all-time record high, and that's through the third quarter. Um, and I think, and this is in nominal dollars, and on a year-over-year basis, I have the data in the text of the morning briefing. I think we're up like $250 billion, which is chump change when you think about the kind of money that's going to be spent in 2026 just on data centers, AI infrastructure. Now, this is high-tech capital spending, and the AI spending isn't just for high-tech software and equipment. It's also for energy infrastructure and all sorts of other goodies, I guess, that are related to developing AI. So some of the strength in here that we're seeing in AI is also showing up in energy infrastructure, I'd imagine. Meanwhile, the corporate cash flow of all corporations, all-time record high, $3.9 trillion. again, the OBBBA tax legislation reduced, will cut slashed the tax rate to zero. Uh, the depreciation is down to zero. So all these 600 billion, $700 billion in infrastructure, AI infrastructure spending, it can be depreciated 100% immediately. That's what I really meant to say. And so that's going to be a big booster to cash flow. And that's something that is a tremendous offset to all these concerns that the tremendous capital spending by AI related companies is going to cut into their cash flow. It will, but there's also going to be a big surge in cash flow from the tax shelter that is commonly called depreciation. Fourth, onshoring, direct investment. Direct investment, this would be liabilities. It's what foreigners are buying here. So, in a sense, standpoint, we owe it to them. It's their asset. So, $323 billion dollars at an annual rate. Yeah, that's a four-quarter sum. So, 323 billion, and that's a pretty large number. But it's again chump change compared to what Trump thinks the change is. He's talking about trillions of dollars that he's brought in through his tariff negotiations, basically beating up on trade partners, not only to uh, for trade concessions, but also for promises to invest in the U.S. The White House website has a total of something like 9 trillion. But these aren't hard contractual guarantees. They're kind of soft commitments, but they certainly are having some impact. We know that some companies like Taiwan Semiconductors are certainly building in the United States, and more American companies are committing to spend in the United States, so there'll be perhaps less direct investments overseas. So that'll be very stimulative for the U.S. economy. Then let's move on to the fifth uh, reason to be optimistic. We've looked at this chart before. This chart is fun. It's the digital revolution. It's the digital revolution that started in the mid 1960s. It shows the percent of the high-tech share of capital spending in nominal GDP. And back here during the mainframes is around 15 to 20% of total nominal capital spending. Now, along the way, we've had the mainframes and the mini computers, we've had PCs, we've had laptops, and along the way, we've had the Amazon cloud, the cloud, obviously, and then AI. So here we are with more than half of capital spending going to technology. And that's got to be less interest rate sensitive. It's more durable, and as we know, a lot of money is being spent in that area right now. Meanwhile, the all this technology, the fifth thing is productivity. So all this technology is boosting productivity. And here's the disappointing development in the labor market. There's been basically no growth in the growth in aggregate weekly hours worked and the labor hours worked in productivity. And yet, the real GDP has been extremely strong, partly thanks to all these stimuluses that some of them started to operate last year. And as a result, we're getting a big productivity boom. Another source of stimulus, six, is fiscal stimulus. The government is cutting taxes for a lot of people, as we just discussed. In addition to that, it doesn't look like the government's doing much about reining in the growth rate of outlays. So we've got deficits of 1.5 trillion to $2 trillion. And yeah, if you want to be a pessimist, people like Ray Dalio are going around saying, we're going to have a capital war. We're going to have an imminent debt crisis, but it's not happening so far. And so far, the positive aspects of all the stimulus are continuing to drive the economy. I'm more sympathetic with the supply side views. of the administration. Warsh, the incoming Fed chair, assuming he gets appointed, is a supply sider. And the supply side idea is that if we can come up with supply side policies like cutting taxes, the tax rates, reducing regulation, and we do in fact get more economic growth out of it, then guess what? You get more revenues to fund the deficit, and the deficit over GDP ratio gets uh, uh, pushed down by the better than expected real economic growth. So, look, the roaring 2020s, that's our scenario, and it is sort of a supply side scenario. Figure 21, where's that? Okay, so we just discussed fiscal stimulus, monetary stimulus. Fed's eased by 175 basis points since September of 2024. I've never been a believer that monetary policy has a long and variable lag when it comes to tightening, but I could asymmetrically argue that maybe it has a long and variable lag when it comes to easing, and we can get some sense that the easing is starting to have an impact in the growth rate of bank loans. And then I don't have charts specifically on the last three, and last three is energy is number eight. Energy is getting a big boost from AI. This administration is very pro energy, especially fossil fuel energy. And we've got plenty of that, and we're developing more of it, and we're exporting more of it. Speaking of exports, number nine is trade, and Trump is doing everything he can to slow our imports and increase our exports. And the jury's out on that one, but we did have a couple of months recently where that seemed to be the case. But it looked like it was kind of aberrational changes rather than something we can say is the beginning of a major change. But it could be. It could be that we'll see the trade deficit narrow as we get more onshoring. And if that's the case, that'll be a positive for real GDP. And I was kind of scratching around trying to get 10 optimistic reasons, and I came up with animal spirits. Because consumer confidence has been depressed. The ISM manufacturing index has been depressed. Even though the economy's done very well, I've been arguing that any data that doesn't support my story is not good data. And I think I was right about that when it comes to the soft data on surveys. Businesses and consumers have been pessimistic, but they haven't acted like that, and real GDP has been very strong. Um, so animal spirits could make more of a comeback if the economy performs as well as I think it's going to perform. Then we should be seeing more of the polls. And I think we just saw the ISM had a really strong January, so I'll take that. The consumer sentiment index seemed a little bit better. I'll take that. So that's where we are. Why don't we open it up? Let me unshare here and open it up for a little discussion. What are your thoughts? This is from Kyle. What are your thoughts on de-dollarization? Is it a multi-year mega trend or just an overhyped premise by financial news? Door number two instead is my pick. I think I think there's no reason to really imagine that we're going to de-dollarize. I mean, gold clearly is making a big comeback here, which is fine, but you can't clear transactions with gold. You still need some currency. You need checking accounts, and a lot of trade is going to continue to be done in dollars. And meanwhile, the U.S. economy remains the world's largest economy with the biggest, most liquid, safest capital market. And I've shown you before that the data from the Treasury shows that foreigners continue to buy our our equities at near record highs of 700 billion over 12 months through November of last year, and they're also buying lots of fixed income securities. So I don't see that as a major issue, but Then again, a weaker dollar certainly helped foreign stock markets outperform the U.S. stock market last year. And December 7th of last year, we uh, changed from stay home to go global, and a weaker dollar would help our go global. But we're not really counting on a weaker dollar to make it work. We're counting on emerging markets to do better. Japan obviously just had a great move here with a new government, and maybe even the Europeans will surprise us. I mean, the stock markets certainly have been very strong over there. Simon, are you concerned with AI tech crash after NVIDIA reports? Some analysts predict a crash if NVIDIA does not report exceptional earnings and forecast. Well, listening to Jensen Huang on Friday in his interview with CNBC, he doesn't, it seems like he's not preparing us for any disappointing news out of NVIDIA. He says the demand for what they're doing is through the roof. So I can't imagine that he's going to tone it down during the conference call. I mean, I think he's pretty much a straight shooter, and so I don't expect that to happen. Uh, Simon asked me if I have a forecast for silver. I don't. I'm not a silver guy. I'm a gold guy. American history was a big conflict between those who wanted gold and those who wanted gold and silver. I'm a gold guy. Silver's got a lot of moving parts in it. You really have to know the production, the supply, and speculative elements of it. Gold actually, in some ways, has become somewhat easier. Um, Ed, I don't remember you ever giving estimates as far out as 4 years, 2030. Are you getting too optimistic? Well, I'm talking about a roaring 2020 scenario. That gets us to what 2029, and the reason I'm now thinking about 2030 is because at the end of 2029, the market's going to be discounting 2030. So I don't. The Roaring 2020s is an optimistic scenario. I think I've laid out all the parts of it, and I think I've kind of kind of moderated my optimism or made my optimism more responsible by acknowledging that the probability is 60%, 20% of a melt up, too much of a good thing, and 20% of a recession. Kevin, last question. How should investors think about the ROI and macro payback period of big tech's AI capex? Productivity boom or overinvestment cycle? As a follow-up, at what point would you expect AI capex to stop being earnings accretive for the leaders and start looking more like an industry-wide cost of doing business? Well, again, there's a lot going on here. I think you got to take into consideration the 100% depreciation of all these data centers in 2026. I mean, that's a huge incentive for capital spending, and it does increase cash flow quite significantly. I don't know that I haven't seen anybody really do the math on it. I guess we'll give it a shot, but. Everybody's concerned that, if they're going to spend $600 billion or $700 billion, 60% more than they did last year on capex, well, that doesn't, cash flow is sometimes almost in these analyses almost assumed to be kind of like a constant. But as Jensen pointed out, cash flow isn't a constant. It's going to be increasing, and there's a lot of back orders that these hyperscalers are responding to. They would be making a lot more money now if they had all this capacity, and that's what they're responding to. And they think that the demand is going to be there and continue to grow. And I happen to agree with it. I came up with a very simple way of thinking about it, and that is there isn't and never will be a shortage of data. And the more data we can process, the more data we're going to create. And so that's something quite unusual about this whole AI IT business that I'm still kind of sorting out, but I'm sorting things out on the positive side for the for the hyperscalers, the tech companies, and obviously the entire economy. Well, thanks for joining me today. Always fun to get together with you folks. We had a nice turnout as we often do. And have a good week. We'll see you next week.